Hey traders, this is Red Ben. We are taking a look at an advanced technical analysis technique where we're going to combine multiple indicators to look for entry and exit signals that are more reliable. A few things I should mention beforehand. Past performance does not is not indicative of future results. None of this is financial advice. I'm not a financial advisor. Just sharing some ideas that I use primarily in my swing trading to see if it might help you come up with some ideas. I do not recommend that anybody risk money in the real markets without talking to a licensed financial advisor. Also, recognize that when you are using any indicator, all indicators are based on price information. So first you have a movement in price, either an uptick or a downtick. The indicators then taking that information, maybe putting it through a mathematical formula of some kind, comparing it to something else, and then printing a line basically. So by the time you see something on an indicator, that has already occurred on the actual market. So recognize that if you are looking for entry and exit signals with an indicator, you're getting late information. These are all lagging indicators. Some of them have smoothing, mathematical smoothing that is going to try to decrease that somewhat. But regardless, making trades on only indicator movements is not necessarily the best technique, especially when you're trading with leverage or trading with a very fast time frame. So, but knowing that, it can still give you some really good idea about what the market is doing to then choose, first of all, whether or not you want to look for a trade with your trade plan on that market, or maybe it's not the time to look for a trade. It might also help you decide which strategy to use to find a trade to enter or exit. So, like I said, just keep in mind as we talk about these things that this is not going to set up buy and sell signals. By the time you see these things, that buy or sell, the optimal buy or sell moment has already passed, but it's still helpful. So let's try to dive into this. It's a lot of information. I'll try to be as brief as possible. So I've got two of my favorite indicators down here. You can do this with many different indicators. Okay, we'll take a look at a couple different examples. These happen to be my two favorites, but you can honestly use pretty much anything. The one on the top is the Fischer Transform. It transforms the market information into Gaussian normal distribution. So what that basically means in English is that these are similar to Bollinger Bands. So as the Fischer Transform moves down towards the lower Bollinger Band, it's saying that price is getting more sold further than usual. So normal is within the bands and near the zero line. The further from the zero line and the closer to the Bollinger Bands it gets, the further from normal, the more standard deviations price is moving. And so it gives you a clue about whether or not this is normal movement, or maybe this is trending behavior, or excess, for instance, can show up on this indicator. There's also a moving average here, the purple, which is just a 26 weighted moving average. It's going to tell you where the Fischer Transform ribbon has been on average over the last 26 periods. We're only using that for two purposes. We're looking at the direction and the location. Sorry, the cat wants to say hello. It's on the bottom. We've got the percent R. This is Williams percent R. This is taking price and comparing it to the previous high and low, basically, of the most recent period. So then that's the yellow line. The white line is a 21, nope, I'm right, 13 EMA. So it's again, another moving average, in this case, an exponential moving average of the yellow line. Just like the Fischer transform, we're taking a look at direction and location in relation to the zero line, mostly, to get a sense of where the market has been going, not necessarily where it is going next, but where it has been going, because like I said, lagging information from indicators. So with just one of these indicators, you've gotten lots of really good information. You can absolutely build some good trade ideas from just one. But what's cool is that you can actually look at both of them and filter out a lot of the noise. And with TradingView, you can even overlay them on each other to see it really clearly. So what I will do, for instance, is I'll take the percent R with the 13 EMA and drop it right on top of the Fischer transform. And then we're gonna zoom in a little bit so it's a little easy to see, and I'm gonna make this a little smaller and this a little bigger. Normally you're probably not looking at your indicator quite this large, but since that's what we're talking about today, we'll leave it nice and big. So this is the S&P 500 daily chart. Doesn't matter, you can look at whatever you want. So what we're looking for is situations, for instance, like this or like this, where the percent R is moving beyond the Bollinger Bands, because again, the Fischer is showing us normal distribution, and the percent R is showing us how much it's moving since the previous period. So while the percent R is not normally distributed, so that's why you get things like this, for instance. You're going to have a sense of whether or not this is normal or abnormal, because of the fact that you can see the Bollinger Bands from the Fischer, and you can then relate the two to decide whether or not you want to trust one or the other. So let's take a look at some of these moves. This is a good example right here. So without looking at any other lines, if we're just looking at the Bollinger Bands, the Fischer transform, the zero line, which is yellow, sorry about that, same color as the percent R, and then the percent R is the yellow. So here the market, came up, was trending, pulled back, went below the Fischer Bollinger Bands. And as that was occurring, the Fischer transform itself was falling down below the zero line. Hopefully you can see that right here. So this indicator was neutral. The Fischer transform was neutral, whereas the percent R was significantly oversold, you could say, right? I'm not a huge fan of those terms, but this is one of the times when it actually does make sense. So you see it all the way down here. And if you're only using the percent R, one way you might decide to base a trade idea off of it is when it gets below a certain level, say 80, and then pulls back above, you might want to start looking for long trades and long setups with whatever your process is. Siamese are very noisy, sorry about that. So if that was your original trade idea, you might find trades just with that indicator, but some of them aren't going to work very well, or you're going to end up missing out on some trades, because, for instance, here we barely went down to 80. Here it went to 79, so you're not quite hitting this one. But if you have a Fischer over it, you can see that it was clearly oversold. And you'd also know, for instance, this is a great example. Here we got oversold, quote in quotes, on the percent R. It seemed to be pulling back into the bullish trend, and a lot of people only looking at the percent R would buy this candle right here, because they'd see the percent R go down, the percent R come back up towards the 50 line. It's first chance to get in bullish, right? If you knew that the Fischer, you can see here, is falling into the Bollinger Bands, and it's also crossing the zero line, you know that this is actually bearish behavior. So you'd think twice about entering here. Plus, the percent R hasn't actually made its way back over the 50 line, and it's not even inside of the Bollinger Bands yet. So it's most likely a retracement within maybe a bear trend. Then it comes all the way back here. Everybody gets stopped out on this candle. the longs, sell, only to see it come back up, right? Kind of classic. So as it comes back up, let's take a look at this one versus this one. So we have the down day in between. And again, here is the real buy indicator candle where the percent R comes back inside of the Fisher's Bollinger Band. The Fischer Transform is flipping to green. The both of them are slightly under the zero line, so it might not always be the exact time to buy, but I'd stop looking for shorts, that's for sure, and start looking for a long setup on this chart. Whereas this one is completely different, right? You don't have all of that confluence here down here. This is actually more of something that you could hold a short through because there's no clear indication that the downward movement has ended. So let's take a look at one other very neat trick, and that is take a look. Let's just take away the actual percent R. Okay. Oh, I wanted to hide that. Okay. And we're just going to look at the EMA of the percent R, and then we're going to actually take away the Fisher itself as well, just for demonstration. Let's see. We'll just do that. Okay. You'll still see some of it, but that doesn't matter. These are just the fill-ins. So, oops, I think I took away the one thing I did want. Hold on, guys. Sorry, must have took this way. Okay, so we're going to take a look at the two moving averages, the EMA of the percent R and the WMA of the Fischer Transform, and then also look at the zero line. You can also add back the Bollinger Bands for even more signals. But what we're going to look for here is how to tell whether or not you are trending or trending up, trending down, or going sideways, or what I call balancing. So the first thing to look for, let's talk about trending behavior. So with trending behavior, what you generally get is eventually both of the moving averages moving up together. So let me just get rid of all these lines. All right, so you can see here this Fisher moving average is still moving down while the percent R is moving up until right about here. Okay, at this point, both moving averages are generally rising, right? Hopefully you can see that. This one and this one, purple and white, are both now rising. So that is right there an indication that you likely are seeing bullish trend behavior. Now, again, like I mentioned before, is this the best time to enter? Are you getting the optimal entry into this bullish trend that ends up, going on for quite some time? No, I mean, obviously the optimal entry was a little bit earlier, right? And there are ways to see that here, but you can certainly do that by zooming into faster time frames. But if you want what we can call confirmation that this is not just a retracement in a bearish trend, but it's actually the start of a bullish trend or a restart of a bullish trend. For instance, this is October 2020, and then it bounced back here. You would know with relative certainty that this was happening when the Fisher moving average moved up and when the percent R moves up. And you have even more confirmation when the Bollinger Bands of the Fisher begin to rise. So you can see here, this is, I believe, the -2 standard deviations. It's not super uncommon for it to go under that or over the yellow. It's quite uncommon for it to go beyond the red. But as it comes back up here and gets back into the normal range between yellow and then tightens here, while the white is rising and the purple is rising, there is absolutely no reason to be looking for shorts on this time frame. Okay. Now, what does it look like when it is the opposite, right? So we can find that by going to a faster time frame. Let's just jump to the current. This is balance. So let's look here. Okay, this looks more like a bear trend, right? So let's take a look at what it would look like early on in the bear trend. Here's balance, here's bear, right? So we've got a percent R dropping below zero line. That's first hint. It's dropping below zero line. The Fischer Transform WMA is also dropping. The top of the Bollinger Band for the Fischer, it was at an extreme level beyond +3 standard deviations. It should not stay there for long. It falls down. At the same time, the lower Bollinger Band is also falling down. So see how all these lines are falling. Even the Fischer Transform is falling right into that Bollinger Band. Classic bear trend behavior. And you're getting this way back here in early September on the 30-minute chart. So, was that the top of the market? No, but it was definitely not a good time to be buying. So you see that, and you should start thinking, okay, well, maybe I should start looking for short setups on retracements. So that's a good example of a bear trend. So let's quickly look at balance, because that's something that confuses a lot of people. Actually, right now is a really good time to look at. We've been bouncing for a bit. Okay, here we go. This is a perfect example of balance, right? Up, down, up, down, up. So if you look at the 30-minute chart, you've got uptrend, downtrend, uptrend, downtrend, right? You can try to play that. If I back out into let's do an hourly. Let's see if I can find a really good example here. Yeah, okay. So hourly chart. We've got Bollinger Bands that aren't really breaking beyond this red line, rarely, maybe just a little bit, rarely getting and falling down below the red. If they do get below the red, they bounce right back up. See that? Bounce, bounce. There's another one, there's another one, there's another one. That's balance. And then generally, if you go far enough out, and if this has been going on for long enough, you'll start to get very flat moving averages. So let me see. Yep. Okay. So here's before the right here. All right. So before we started to drop, we had a period here, number of days, where we had relatively flat moving averages. Okay. Now this is interesting because the percent R had been rising and is actually above the Bollinger Band. So that is a indication that it should be in a strong bull trend, right? The Fischer Transform moving average does not confirm this. And once the percent R drops, the moving average for the percent R drops down below the Bollinger Band, what do you know? Everything starts to turn down, right? So this was balance in here after a bull trend and then bear trend. If I zoom in a lot, we should be able to see more balance relatively often. Let's just find like a nice little balance day. Okay, right in here is a good example. This is where it starts to end. You can see the bullish action where all of these are rising together. Eventually, the Bollinger Bands break beyond the red line and they stay beyond the red line, only pulling back inside the normal range and then breaking right back out again. Bull trend, right? On the other side, we have the exact opposite. This one didn't fall quite as nicely, but still you have all three falling down. The Bollinger Bands broke outside of normal and then right back into it. So in between is our balance. So you can see here, because of the relative location of the EMA for the percent R, it was bottomed out, right? So if you're just using that to decide if you want to buy or sell, most places will say, okay, it's oversold. You should be buying here. Well, that's going to be pretty tough. You're going to buy this one or maybe this one. I mean, look at these candles. Just look where this is going. Buy this one? That's a great idea, right? No, horrible idea. Maybe I'll buy when it comes back up over the 70 line. Oh, got stopped out again. Maybe I'll buy, here. Well, that one actually worked, right? You get a little bit of a pullback and then it goes. So what's the big difference between this one, this one, this one, this one, this one? It's not the level of the EMA, right? What's the difference? The big difference is Confluence. Here, you've got the Bollinger Bands tightening up. You've got the WMA flying up. You've got the Fischer bottoming, not at the bottom of the Bollinger Bands, but now at the actual MA. See that? Pulls back, bounces right off the MA, breaks right back over the zero line, and it never comes back under there before touching the other Bollinger Band. Look at that. By the time it gets here and touching the other Bollinger Band, if you go back to the idea of if it's that it's overbought, you're selling this. That's wrong. It's absolutely wrong. And you would know that because unlike here, when it's right, where the Fischer touches the Bollinger Band and you get a pullback, here it touches the Bollinger Band, it breaks out further. You would know that if you were watching another indicator like the percent R, which is actually breaking out into a bull trend. Whereas here, it's definitely not doing that. It is flat. Nothing's really happening, and if anything, it's pulling back into the normal range and then dropping again. If anything, it's setting up a bear trend. But you can see that the Fischer moving average is not getting over the zero line, or if it does, it's maybe for one candle, a little bit of a trap there. If all you were watching is the Fischer, although this really is not that bullish. But you come up here, turns right around, can't get over the zero line, right? If we were looking at the other side, if we were up on top at balance, it would come back. It would come down to the zero line and then it would bounce. So if we find something that's relatively bullish, so I'm looking for a percent R that is flat on the top of the screen up here, all by itself. Let's see. Right here, it's not great, but you'll sort of see the example. So here you've got percent R way up high. You've got a Fischer moving average rising up. It comes down, it breaks the zero line, and what does it do? It bounces right back again. Boink, right? So this is more balance. This is a good example of balance. Again, harder to see because we're so zoomed in. Zoomed in, it's tradable on the short side. There's definitely short entries here. So you can short that, you can short that. But if I take the same area, September 1st, I back it out, it's gonna look like balance here. Okay, this is balance, right? Under, over, under, over, under, back and forth, back and forth, back and forth. So it's like, okay, so let's say we're in balance. How the heck do you trade this? Well, let's put the percent R back on. And the best way I have is you look for excess. So here's some excess. On the buy side, there's some excess. On the buy side, there's some excess on the buy. This one's a little dangerous because it's rising, right? Everything's rising. See that? See the difference? Hopefully you see the difference. This is like in the process of rising. This is really not. This is starting to look a lot more like excess a lot sooner. Okay, excess. Let me point this out and then I'll show you the difference here. It can get a little confusing. Those are excess highs. Okay, excess lows. Let's just mark these off. Okay, we have one there. Here, I can just do it this way. One here. We got one here. Here you go. Oh, sorry about that, guys. Here. Right? Yeah, hopefully you see what I'm talking about. So percent R itself is going beyond the Bollinger Band. That itself is not bearish. It's usually bullish. If you see when it actually happens, this point right here, this is bullish. On a higher time frame, this looks like a bull trend. Faster time frame, it looks like a bull trend. But what is not so bullish is when it falls back inside. And when the EMA comes back in, you know for sure it's not going to bounce anytime soon. Okay, you're not going to get boing. You're not going to get that because even the EMA has now fallen back into the normal range. Even the Fischer moving average is dropping. Okay, now you don't just want to short and trail stop because it turns out it's going to be balanced. How would you know that? Let's say you shorted this right here. You shorted this candle. Okay, maybe the break right there. You see that everything's falling. It was recently in excess. The percent R has dropped back below its EMA, even below its Bollinger Band, and the EMA is falling. And this is starting to curl over. Fischer's curling over. It's far from the lower band, right? Everything looks like it could be starting a bear trend. So you get down in there. You see it come down here, it starts to bounce. Okay, so you're thinking, okay, is this a bear trend, or is this a bull, or is this bounce? So this suggests here that we might be getting a bounce because it's gone way beyond the Bollinger Band. Okay, bounces back up. Where does it turn around? That's what we're asking. Where does it turn around? It turns around before the zero line and before the white EMA. And that white EMA is dropping. What else is dropping? The Bollinger Bands and the Fischer moving average. Is this going to continue? Probably. Is it going to make a new low? We don't know. That's very, very, very important that everyone misunderstands. If you're using indicator training alone, if you're using indicators to make decisions, you do not know what's going to happen down here. You would have to have more information on order flow and the volume profile, things like that, to have any reason to think that we're going to go lower because of like unfinished business, for instance, down here, or maybe be watching here for signs of disinterest on the buy side. You could also zoom in a bit and get some more ideas. But the point is that here you don't know for sure that this is going to bounce. And once it gets here, you don't know for sure that it's going to fall again, right? But the fact that everything is still falling, all the lines are still dropping, and this percent R has not yet reached its EMA on the climb, is a good reason to not get uber bullish yet. We should be expecting continuation, especially if momentum has been so heavy, until we see evidence otherwise. Okay, let me just erase these so it doesn't get too complicated of what I'm talking about here. So let's look at this one next, okay? We break below it, looking pretty bearish, but we can't make a new low, okay? This is higher than this is higher than this. It's no new low, and it breaks back into into the Bollinger Bands of the Fischer right there. Okay, so this candle, once it closes, you know that bear move for now has ended. Why? It's crossed over the EMA. The EMA is starting to turn up. This EMA is no longer dropping so heavily. Look at the Bollinger Bands. They're tightening. They're not dropping. They're not expanding. They're not, down here. They're relatively centered. Okay? It's not necessarily a buy yet, but it's not a time to be reshorting yet. We should not be reshorting or selling something when this is actually rising and we're looking more like a neutral position here. If you were short from up here and you're still short here, there is no reason not to take some off. Now, especially when if you stayed in for a couple more hours and you see this just failure, no interest below. Sellers are not interested below at all. It's not able to get down. It actually goes below its EMA and bounces right back up again. So, which is actually a buy signal right here. So now let's look at this one. Okay, bullish, right? You've got percent R rising, percent R EMA is rising, the purple Fischer MA is rising, top Bollinger Band is rising, Fischer is nice and green. This is bullish behavior. So when should you get in? We can talk about that. Everyone always wants to know, how do I know when to get in? Again, it's an indicator. It's going to be late on this time frame. But let's just take a look, because this is a pretty cool example of when you know to get in. Okay, it tries to sell off. See this right here? If it was bearish, what happens? It breaks. Look at this. It breaks below and it keeps going down, right? That's classic bearish behavior. It sells, it triggers under the EMA and it just keeps going. Here, it triggered under the EMA, probably caught a few latecomers stops and just reversed. So that's a great, example of a place where you should start to look for buys. Here's another one. It comes back, it pulls back into the Fischer and bounces, right? What about this? Uh-oh, we're not going anywhere, right? Starts to drop. This is a sell signal. This is a sell signal. So I hope some of this is making sense. I'm going to run it up on 30 minutes, which is longer than I wanted to go. You can do this with any indicator, you guys. Just start looking at Confluence and where they go together, where they start going, up together, down together. If they're going in opposite directions, it's probably balancing. So again, this is Red Ben. Please, give me some questions, give me some comments. I'll do some follow-up videos soon, and hopefully this is helpful. See you guys. Good luck trading.